Every single year, I watch business owners overpay in taxes, not because they don't work hard or make smart money moves, but because they don't understand the tax code. That's why this bill just changed everything. On July 4th of 2025, Trump signed into law what he called Trump's Big Beautiful Tax Bill. And if you're a business owner, a real estate investor, and even a W-2 employee in certain industries, this bill includes updates that could seriously cut your tax bill starting today. When I shared this with my clients, they were shocked at the amount of tax savings that they're going to be able to receive starting in 2025. And a lot of them had no idea how much money they were leaving on the table. So in this video, I'm going to walk you through the biggest updates from this new tax law that affects everybody: business owners, real estate investors, and some W-2 employees. I'll explain one literally in English terms so that you understand what the heck is going on. And I'm also going to show you how to use them immediately. Hi everyone, I'm Anna. I am a licensed CPA and a tax strategist, and every single day I help business owners and real estate investors legally lower their taxes and grow generational wealth. To be honest, when I started my firm, I used to think that tax planning was for multimillionaires and big corporations. But over the past few years, I've helped hundreds of everyday small business owners use the same strategy that wealthy people use every day. And with this new tax bill, it's about to get better. So let's get into it and break it down. Let's start with something that applies to everyone: the standard deduction. The standard deduction now is $15,750 for single filers and $31,500 for couples filing jointly. This is the amount that you can automatically, as a freebie, the government gives you that you can automatically deduct from your adjusted gross income. No receipts required. To put this into perspective, let's go back to 2017 before the Tax Cuts and Jobs Act was enacted. This is what a single filer was getting as a standard deduction: $6,350. Today, it's $15,750. We might have forgotten how small those amounts were, but I'm here to remind you that these are amazing. Also, here's an extra tip. Side note: if you have a business and you have children, you need to start paying your children. You can pay them up to almost $16,000. Not pay any taxes on it, not file a tax return. So I'll leave the video below for you. So let's go back to this. For example, let's say in 2025, you're a single earner and your W-2 is $60,000 and you take the standard deduction. That means that you're only going to be taxed on $44,250. That is how the standard deduction works. Let's talk bonus depreciation. If you have no idea what this is and why people were going crazy about bringing bonus depreciation back to 100%, this is why. It is a huge win for business owners and real estate investors. This is what actually allows you to write off on paper huge amount of money and pay zero to no taxes on all the money that you made. AKA, this is literally how rich people pay zero taxes. So how does this work? Let's say you have a business. Let's say you have a roofing business. Let's say that you net $200,000. And you need to buy a new truck for the roofing business. Let's say it's an F-150 and you use it 100% for work and it's $85,000. It's not brand new, but it's new to you. What this bill does for that business owner will get an $85,000 deduction against their taxable income. So instead of paying taxes on $200,000, you reduce that by $85,000. Now that business owner will only pay taxes on $115,000. But you want to know how you can literally take this to the next level and 10x it? It's by buying real estate. Real estate investors, aka rich people, are able to buy big buildings, take bonus depreciation, and take a really big loss against their income. I'm going to leave the video below that got so much hate on the internet, but I'm telling you, this is how wealthy people do it. So go do it. Let's move on. Number 3, Section 179 has increased. This is also for business owners who buy equipment. Now, if you've never heard of Section 179, what you need to know is that you get immediate write-offs. But now the new limit is $1.5 million that you can write off using Section 179 against your business. This is great for companies who have to purchase a lot of equipment, a lot of big items, big assets. You have $1.5 million that you can use Section 179 for. Number 4, auto loan interest is now a deduction. The way that this works is this new bill is giving people a max $10,000 deduction on their auto loan. Here are the rules. It starts in 2025 and it ends on 12/31/2028 when Trump is no longer in office. This is for personal use vehicle only. You also must have first lien on the vehicle. When you file your tax return, you're going to have to include the VIN number of your vehicle on the tax return. But here's the thing. There's a phase out, there always is. So for single filers who are making over $100,000, it will start phasing out, meaning you're not going to get the full $10,000 if that's what you're going to get. Or if you are married filing jointly, it will start phasing out when your modified adjusted gross income starts going over $200,000. Let's move on to the next one, which is for those people who have children. The child tax credit has now been increased. It is now $2,200 per child, and $1,400 of that is fully refundable to you, meaning if you have zero taxes, depending on the number of children you have and the income that you make, you can get up to $1,400 back, actual free money from the government. Again, there's always going to be thresholds. So for single filers, this starts at $200,000, and for those who are married, it starts at $400,000. One of the big things that Trump did in a lot of these new tax laws is that a valid Social Security number is required at the time of filing for this credit. State and local tax deduction, aka the SALT deduction that a lot of people are talking about. What the heck is this and how does it work? So, if you itemize deductions, earlier we talked about the standard deduction. If you itemize, which is the other option, you will file a Schedule A. Before this tax law was enacted, for people who were paying state and local taxes, the max was $10,000. If you live in states like California, that is literally so easy to hit, right? So what this new tax bill did is it increased that limit to now $40,000. So that means that if you have $50,000 of property state taxes, you are allowed this year $40,000. Instead of last year, you were only allowed a $10,000 deduction. Here's a tax planning opportunity that you should discuss with your CPA for 2025. With this new deduction, and if you're looking for more write-offs, you might want to prepay your 2026 taxes in 2025 so you can get that deduction this year. Let's talk about the no tax on overtime for W-2 earners. How does this work? Now, we finally got some guidance, and here's what this means. It starts in 2025, but it ends on 12/31/2028, again, when Trump is no longer in office. You can deduct, if you are single, up to $12,500 or $25,000 of overtime if you are filing married joint, okay? Your employer must actually report this overtime completely separate from your regular time on your W-2. So that's going to make it a little bit harder and more, tax filing for your employers, but it has to be reported separately. Of course, there's always a threshold, you guys. This deduction starts decreasing as soon as your modified adjusted gross income gets to $150,000 if you're single, or you are married at $300,000. Let me give you a real-life example of how no tax on overtime actually works. Let's say Johnny makes $18 an hour, he is single, and his modified adjusted gross income is $53,500. He's under the limit. It started in 2025, so he is okay. In 2025, he worked 27 hours of overtime at his overtime rate, which is $27 an hour. So the total overtime that his employer paid him was $729. What is the actual deduction that he's going to see on his taxes? It is a total of only $243. How do we get to that number? It's $9 times $27. $9 is the difference between his regular hourly rate of 18 and his overtime rate of 27. 9 times 27 hours that he worked overtime. His deduction is only $243. That is how no tax on overtime works. The other new bill that was enacted was the no tax on tips. Let's talk about how this is going to work. It does start in 2025 and it ends again on 12/31/2028 when Trump is no longer in office. Now, this is a deduction for up to $25,000 against your income on your tax return. Everybody was freaking out. Everybody was thinking, well, now I'm a CPA. Maybe I should start, asking clients to tip me instead of giving me money for my services. The IRS is way ahead of you. They've already outlined some of the services that are not included. For example, medical workers, CPAs, attorneys, consultants. This is really for those people in the service industry. And the biggest thing is to realize that the IRS already knows what type of business it is, and the person who is tipping has to do it out of their discretion, whether they want to or they don't. So another thing is that your employer is going to have to report these completely separate from your regular hourly time that you worked, and you can find this deduction on your tax return. Let's move on to the next one. For any company that invests a lot of money into research and development, such as SaaS companies, this new tax bill can literally change how much money you're going to pay on taxes. Here's how it works. Companies that invest money in research and development before this tax bill had to amortize those costs. So imagine if you're spending $500,000 on research and development, you have to amortize those costs. That's going to take a long time to take that expense. This new bill said you can 100% take those research and development costs as an expense. And not only that, you can go back and amend your returns if you need to. Now, if you're in research and development and you have a lot of amort cost sitting on your depreciation schedule, this is a tax planning strategy for you. And the last one is opportunity zone funds have been expanded as well. So, opportunity zone fund credit is if you have a big capital gain, let's say you sold your stock in Apple and you are going to pay taxes on $500,000 of that, you can take that money and actually invest it in an opportunity zone in real estate and be able to defer a lot of those gains and actually wipe them out if you hold them for 10 years. So if you have big capital gains, this is a time for you to look at where you can invest that capital gain into real estate to minimize or avoid your whole capital gain. Let's go through a quick recap of what we talked about, right? We talked about the standard deduction. We talked about bonus depreciation now being 100%. We also talk about Section 179, being able to take a write-off on your auto loan, a bigger child tax credit, no tax on tips deduction, no tax on overtime, opportunity zone credits, and research and development being 100% a write-off now. So what should you do with all of this information? If you think that any of this can pertain to you, you should talk to your tax strategist and talk about these new tax bills and see if they can actually work for you or why they cannot work for you. You guys already know I love to play the IRS game just like wealthy people do. So if this video helped you, make sure you subscribe to my channel, hit the notification button so you don't miss any of my videos. And if you want to apply these strategies that your CPA is currently not helping you with, book a call with our team. We'll be able to help you. Thanks always for watching, and we'll see you guys on the next one.